Welcome to the Wheelbarrow Profits Podcast, where you get multifamily investing made real. Learn from top players in the real estate investment world as they share their secrets with you and discover proven strategies on apartment investing that actually work. To learn more about Wheelbarrow Profits, visit jakeandgino.com, your one-stop shop for everything multifamily. Now to your hosts, Jake and Gino.
Hello, everyone. My name is Gino Barbaro, the host of the #1 multifamily podcast on iTunes. Today I'm flying solo. My boy, Mr. Make It Happen, Jake Stenziano, is not here. On this podcast, we're going to be talking about financing today. It's the third leg of our framework. My guest today is Ricardo Hinojosa, the Senior Director at Old Capital Lending. His passion lies in working with investors and specializes in securing debt for all types of commercial real estate, including multifamily, office, retail, land development. And without further ado, let me introduce Ricardo to the show. Welcome, Ricardo. How you doing?
Hey, Gino. How are you? Thanks for having me. I appreciate the time.
Thanks, Ricardo. Let's just jump right in. I want all the viewers to listen to your background, how you got into real estate, and what you're right now.
Definitely. So I actually started in real estate about 5 years ago. Similar to a lot of your lists, and in the corporate rat race, if you want to call it, for a long time. I actually have a background in corporate finance. So I was with a large multinational corporation, PepsiCo, in a number of roles, primarily with their Frito-Lay division across the country. Again, in corporate finance, did that for about 14 years. And as I was doing that, I had read a lot, had always had, real estate in the back of my mind. Read Rich Dad, Poor Dad, got into, got on, online networking sites like BiggerPockets and, started reading about real estate. And my wife and I wanted to start building some sort of a passive income. Our thought was, hey, for retirement purposes, to kind of, at that point, I didn't have a sense that, I was going to leave the corporate world, but it was just, how do we start building something, outside of our W-2 income? And I started with single family. And while I was still in the corporate world, did a couple of single family rental properties, did a couple of flips. And, as I was doing that, obviously you start building a team, you start networking, trying to figure out, okay, what are the best, vehicles for kind of what I want to do. Long term, and I'd met an individual at a networking group that, we got to talking, and I was like, hey, this fix and flip thing, probably isn't for me. It's just another job, and I really didn't want another job at that point because I was totally, dedicated to what I was doing in the corporate world and wanted to progress there. And he said, hey, I'm investing, passively in a number of apartment deals. Multifamily. So we got to talking, and he pointed me in the right direction on who to talk to here in the Dallas-Fort Worth market when it comes to multifamily. So I started digging in and started, researching and getting educated and things like that. And once I started digging in, it really, the numbers really clicked for me. I'm again, finance background. I'm a numbers guy. So when I started seeing, some of the numbers within the multifamily business and how you can really scale the business, how you can own an appreciating asset that delivers passive income, and then, you've got levers to play with to, grow the business and drive NOI and drive valuation and deliver returns that way. It really made a lot of sense to me. And shortly thereafter, I'd made the decision. I'd met some partners, really started to build a team, met a partner that was willing to go into business with me. And at that point, I decided to leave the corporate world to invest in multifamily. And as I took that step, again, I'm building my team at that point, meeting with different individuals, trying to figure out, okay, what's the best strategy for me to take. I met a gentleman by the name of Paul Peebles here in Dallas, who is in the lending business. And I'd approached him, from the perspective of an investor saying, hey, I'm about to make this big decision on leaving the corporate world, and I want I've got some capital in place. I've got a team, a network that I've built. I think we've got a business plan that makes sense, and I'm confident with going forward. What is your take from a financing standpoint? It's going to impact me, going forward. And we got to talking, developed a pretty good relationship. And at the end of the day, he'd say, hey, I think your background, kind of what you want to do, why don't you come join our team and really learn the multifamily business, kind of get into the details, understand the lending side of things. You can help us, build our business, work with new clients, and then also build your business at the same time. So it was kind of a win-win situation. A lot of the guys here at Old Capital are also investors as well. So not only do we, help individuals finance loans, secure debt for properties, but we also invest ourselves. So we've got a good feel for both sides of the table and what investors are looking for when they come to us for financing. So I know that's a lot, kind of a long-winded answer, but that's kind of how I got started, and that was about 5 years ago when I started digging into the single family, got into multifamily about 3 years ago. And that's also about the time that I started with Old Capital on, consulting individuals, helping individuals find optimal financing for their investment properties.
Well, I want to make one comment. I think it's really awesome that you left your corporate world and went to work into multifamily. I usually tell people that they're on the fence, go get a real estate license, become a real estate broker, start mirroring people, give value for value, create a win-win situation for somebody, for a mentor. And I rarely hear people leaving their job and going into the, mortgage business or the financing aspect of it. That is an awesome leap. I love that. I think anyone out there listening, that's a great way to get into multifamily because you're going to understand the financing aspect of it. And it really is all about the numbers. Ricardo, where did you find your education when you were getting into single families and transitioning into multifamily?
So as I was transitioning, again, did a lot of reading. I'm kind of a bookworm. I'm always online trying to read and learn. Found a couple of networking groups that were really catered to single family here in the market that I was in Dallas. And they were educational groups, so networking educational groups. And they were really focused on single family, though. I learned a lot. I started getting into the business and really just took action. Hey, I want to find a deal. I want to find a single family home. Who do I talk to? So just kind of, pounding the pavement, hitting the streets, finding people that had done it, that had been successful. And then one thing led to another as I was kind of refining my approach on what I wanted to do. Realized single family wasn't the right road for me, but that's how I met, multifamily investors. So that kind of led, one action kind of led to another. My first path wasn't the path that ended up being right for me, but it led me to multifamily. And in multifamily, there are a number of, there's all types of educational groups out there, whether it's online, whether it's, there's meetup groups all over the country. There are mentoring groups, a couple large ones here in Dallas that I'd worked with. And that's where I met a lot of the individuals that ended up being on my team, so my partners, that have, helped me from an acquisition standpoint, go out and buy multifamily property. And then, also is how I found my way to, the lending side of the business, where I'm now helping individuals get into the business themselves.
That's awesome, guys. Whatever you focus on grows. He saw the residential aspect didn't fit his model, and he was intelligent enough to say, "Listen, single family, that's not my way to go." And he just found his way. He was in the grind, and whatever he focused on grew. And he met his person, and he networked, and that's the way you got to do it. Since you've been in this, just tell the listeners what you think the biggest differences are between residential and commercial lending.
Yeah, so I get that question a lot. I did work with investors of all levels of experience, but we do, because of our approach in the way of, more of a mentoring approach with our clients, we do get a lot of first-time investors, and a lot of them come with, the single-family experience, and most people have bought a home, and they've got this thought about, hey, what the lending process is like, and it's extremely different with commercial. So in residential, obviously, when you buy a home, it's they're looking at your creditworthiness, your financials, your W-2 income, your tax returns, and that's the decision-making process within the commercial business, and specifically multifamily. The lender does look at your financial capability, but they look at it a little differently. It's not just your earned income or your W-2 income. They really want to see, what does your balance sheet look like? So there are a couple of main factors. Income is important for for certain types of deals, but really they want to say, okay, what is your net worth? What does your balance sheet look like? What are your assets? What are your liabilities and your contingent liabilities? And then they also want to understand your liquidity. So cash is king in this business and in most businesses, but they want to make sure that you've got the right amount of liquidity to support the business that you're getting into, because you're really buying a business when you're buying a multifamily asset. And then the other piece of the puzzle is the property, right? So it's the individual, your net worth, liquidity, and the experience you have and what you bring to the table with your team. And then it's, the asset. So the lender's going to want to, make sure that you as an individual or you as a team are coming in and they're going to want to make sure that that's a good fit, right? So a first-time buyer, a lender's not going to be comfortable with you going in, buying a huge value-add deal that's 70% occupied that needs $10,000 a door in rehab, and that the operations are a mess. That's not a good fit. So the lender, especially for first-time investors, are going to want to make sure that you're going into a deal that makes sense for you and your experience, and that they're setting you up, or you're setting yourself up really for success. So those are kind of the main differences. Is, hey, you're buying a business. It's not just about your creditworthiness. It's about the experience that you bring to the table, your net worth, liquidity, and then the asset that you're buying. So the big decision is made on the asset, from a lending perspective.
I'm glad you said that, because what happened when Jake and we bought our first deal, we partnered. And I think partnerships are excellent for all the things you stated above. You have two balance sheets going into the deal. You have, we have obviously had more liquidity. I had the experience of actually owning a couple multifamily. Had none, so he leveraged that aspect of it. But it just gave us much more, credibility to go in with partnerships. So I always tell people, if it's their first deal and they're really worried they're not going to be able to get this asset, look for a partner. Look for someone who wants to get in with you. It'll make it a lot easier for you to get that deal.
Absolutely, and a lot of that is critical. I mean, that's one of the things that kind of where we add some value is a lot of investors will come to us and they'll say, hey, here's what I've got. So the first thing I say, hey, send me your personal financial statement. Let me take a look at liquidity, the real estate you own, how much experience you have. And if you can't do it on your own, then the nice thing is, in the multifamily world, it's not just about you. It's who you can bring to the table. So a lot of times, if you've got a deal, it's not whether or not you can get the deal done. It's what do you need to get that deal done. So, you may not be able to take down a 100-unit, 200-unit property by yourself, but I can help you understand. Okay, you need to go find partners that fit this mold. You need X amount of net worth, X amount of liquidity, and you need to find some experience and get some experience on your team in the form of a partner or a very experienced property management company, where we can build a story around you and your team to be able to take down the deal.
I like that. Before talking about how you bring value to your clients, I just want to briefly the different types of commercial lenders out there, because sometimes people can get confused. Banks, conduit lenders, agency lenders. Can you go through the gamut of the different types of commercial lenders out there?
Yeah, so let's just talk about a couple of the most common. Probably sure. 90 to 95% of the clients that we work with in multifamily will either end up leveraging banks, so community banks, or agency debt. So let's just start with community banks. Community banks are, you're dealing with mom and pop's money, grandma's money, Those are usually going to be smaller deals. They hold them on their balance sheet usually. Internally, they're smaller, but not always smaller. It's usually deals where either the property or the investor is not ready for agency debt. Agency debt is considered kind of the gold star of multifamily lending just because of the terms associated with it. So if the deal is not right for agency debt for whatever reason, whether it's it's not stabilized, or it's too small, or the borrower just doesn't have the experience needed for agency, a lot of times we'll work with community banks usually in the same market that the property is in. So it can be a little challenging because not every bank is going to lend on banks like to lend on different deals and on different types of deals at different times. So a certain bank is not always going to be interested in a multifamily C asset in the DFW market. It can change over time. So, probably I would say 50% of the deals that we do end up going to kind of regional or community banks. Those are usually going to be full recourse on loans. Terms, on the deal, just in general, it's going to vary greatly, but usually amortization, 20 to 25 years on those types of deals. Usually about a 5-year term. Rates right now on those types of deals are high 4s to low 5s on a fixed interest rate deal. They're not always fixed rate, but that's kind of a general kind of overview of kind of what those types of deals would look like. And again, it's most community banks are probably, they can vary in terms of what they want to see and what they're interested in. So that's kind of the nuance of the community bank, is that it's sometimes can be a challenge to find the right lender. So that's kind of where we come in to kind of help you kind of, okay, who's the right lender for your specific deal is not always easy to find. So that's a community bank. The other big one is agency. Primarily Fannie Mae and Freddie Mac are the two big players in the market. Those are usually going to be larger deals. Usually over $1 million loan amount. Fannie Mae will actually come down to $750. And the advantage to those deals, or to that type of financing, is that, for one, it's most of them are going to be non-recourse to the borrowing group. So when you say non-recourse, it's non-recourse excluding there are certain carve-outs within the loan. They're called bad boy carve-outs in the industry, but essentially it's non-recourse as long as you don't commit certain types of fraud. So if the deal goes under and everything is clean and you haven't committed any fraud, then it's non-recourse to the borrowers. So that's kind of the big win for agency debt, and why most people would prefer to go the agency route versus community bank route is the recourse piece. And that's big from a number of angles. One of the big things that the people don't realize is that when you've got a non-recourse loan, it doesn't count against you on your balance sheet. So when that next lender is looking at you in terms of contingent liabilities that are on your balance sheet, a non-recourse deal doesn't count against you. So it helps in your ability to scale up your business. The more you can have non-recourse the more non-recourse loans you have, the greater your flexibility going forward in terms of being able to scale your business, if that makes sense.
That does. That's really important. A lot of high net worth guys look for that, actually. And there was a deal here in Knoxville that was it was a pretty non-conforming type of property. And, a group came out of New York. They tried to bid on the property. It was a hedge fund. They tried to get non-recourse financing, and it was not, they couldn't get it. Deal fell apart because they couldn't get the non-recourse financing. So I think people have to take a look at that. If their exit strategy is to flip the property and get out, they have to look and see, is this property able to get non-recourse financing or agency debt on it? And that will affect the valuation of the property. And that's what it did on this deal down here.
Yeah, absolutely. And there's non-recourse. Usually, you're thinking of, when you think of non-recourse agency debt, you're thinking of long-term debt, and that's primarily what is out there. There are some shorter-term kind of bridge products though, where even if it is a short turnaround, we do have some non-recourse bridge lenders that we work with that. Again, it all depends on the strategy of the deal. Kind of what's the long-term strategy for that deal. If it's a short-term fix and flip, then we're probably not going to point you in the direction of a 10-year kind of Fannie Mae note. It's what's right for your specific project. So that's Fannie and Freddie. I mean, I would say those are the two kind of gold standards. The differences between Fannie and Freddie, there are a few nuances. I'd say right now, Freddie Mac's got a very attractive, especially for new investors, kind of one unique product I'll point out is their Freddie Mac small balance program that we're doing a lot of right now. It's for smaller deals, loan amounts of $1 to $5 million, non-recourse, 30-year amortization. They've got a 5, a 7, and a 10-year term available. Interest only is one of the nice pieces to that product right now. On a 10-year term, we can get you up to 3 years of interest only on that product. And then the other nice thing, especially for new investors, is Freddie right now is a little more lenient on the experience side. So we talked earlier about kind of what the criteria is, for an investor coming in and purchasing a property. It's your net worth. You have a net worth of at least equal to or greater than the loan amount. Liquidity, post-closing liquidity, equal to usually 6 to 12 months of the debt service, and then a certain amount of experience. So lenders are going to want to see that you've got experience of a similar type of property, similar multifamily experience, and that you've owned multifamily experience in the past. Well, with the Freddie Mac Small Balance Program, what we've been able to do is work with some of our underwriters specifically, and we've done this across the country, where you may not have the ownership group may not have the experience, but as long as we're partnering you up with a property management company, third-party professional property management company that has significant experience in whatever submarket you're purchasing in, they'll count that as experience and for your team. So we've closed a ton of deals, I'd say, over the past year on that Freddie Mac Small Balance Program, where historically it's, hey, you've got to have multifamily experience. But right now what we're able to do is get that done with, as long as you have experience on your team in the form of a experienced third-party property management company, we've been able to get that done. So that's a unique aspect of that Freddie Mac Small Balance Program.
Yeah, that's really...
No, it really is, because it really takes... Go ahead, sorry.
No, I was going to say we had a very similar deal like that where we're actually assuming a property, and they wanted a third-party experience. And fortunately for us, we had the management company in place and everything. But if you're coming in there, and it wasn't a huge deal, it was only 97 units. So, I mean, people could take down 97 units on their first deal. And if they can get that third-party management, that is huge.
No, it is, especially for first-time borrowers. A lender's going to want to make sure that the property is in good hands. And you can have the strongest net worth and liquidity, but if the lender's not comfortable that you're going to be able to operate the property the way it needs to be operated and be successful, then they're not going to have a level of comfort with you. So it's key that you got that knocked out up front.
I agree with that. Let me ask you, how do you bring value to your clients?
Yeah, we've talked about a number of things, but I think is under what the investor is looking to get out of whatever project they're undertaking. So it's sitting down with you up front, understanding your current situation, and then providing guidance, like as I mentioned earlier, about what do you need on your team. Because we get a lot of first-time investors that come in, have got capital to invest, good net worth, good liquidity, but they really don't have a good feel for, okay, how do I pull a deal together? How do I really accomplish what I want to accomplish? And that's kind of what we specialize in, is, being able to lay that roadmap down for the investor. Let them know, hey, here are the property management companies that you need to contact, or this is the type of property management company that we're going to need for this specific property. What type of property should they be going after? So I think that's really where we add the most value, is up front, before you start, or as you're putting your team together, as you're looking for properties, especially in the markets that we work in, where we can, investors a lot of times will just shoot me deals, send me emails, hey, this is what I'm looking at. And because I know what they're looking for, I know what team they have in place, I can provide them guidance on, here's the type of financing that would be, feasible for this type of asset, or, hey, that's not for a first-time investor. Don't waste your time on a deal like that, because it's going to be an uphill battle to get something like that done. So really providing the guidance up front. And we take a lot of pride in, with our investors, the ones that if we tell you we can close the deal, we're going to be able to get that deal closed. We've got a ton of experience in the office. We see, where an investor may close on, maybe a couple of transactions a year. We close on, hundreds of transactions every year. So we know who's lending, who the right lenders to go to. And we want to make sure that, when you're putting your earnest money up front nowadays, deals are extremely competitive. A lot of our clients are having to put quite a bit of money hard day one. And when you're doing that, you want to have the confidence that you'll be able to get the deal closed. So I think certainty of execution is huge, especially right now in this environment, competitive environment that we're in. And I think that's one of the biggest things that we bring to the table, is if we tell you we can get a deal done up front, we're going to be able to find you a solution. And we're usually pretty, rarely do we miss on that.
I think that's really important. Real estate is all about networking and team building. So if you can get your financing portion and get somebody who's really can step it up, and you're confident as an investor that you can lock this deal down, you'll feel more confident in putting in your offer, and it'll just make everything go so much more smoothly. How has lending changed over the past 5 years? You got in 2012. How has it changed? Because I can see this Freddie Mac SBL coming out. I see the programs coming out. What have you seen in the last 5 years that has changed the lending industry?
Yeah, I think the Freddie Mac has, when they hit the market, and it was probably about 2 years ago now. When they first hit the market, it was a splash, but they had there were some kinks in their processes. And Freddie Mac, I would say about a year ago, really started getting their ducks in a row and getting aggressive. That has definitely changed things, and for the better. When I say they're getting aggressive, they're still, solid underwriting principles. So, we're not in the market where, lenders are not doing due diligence and just giving loans out to anyone that can fog a mirror type of thing. Underwriting principles. Yeah, I mean, I've heard stories around, before the market crash of, 07, 08, as we're hitting that, in terms of how things were then, that's not the case right now. I mean, lenders are still going through the due diligence. Property's got to cover its debt service. Both Freddie and Fannie have got pretty stringent requirements for the property. But there is a level of aggressiveness on from Freddie and Fannie's perspective. They're wanting deals. They've got a ton of money to lend right now. So it's an aggressive market, but I think a healthy market, and there's a healthy balance between aggressiveness from lenders, but then also making sure that they're making good business decisions, and that we're not getting ahead of ourselves in terms of where we are kind of in the cycle. So I would say that's the biggest over the last few years, kind of what I've seen.
Hey, Ricardo, let me ask you. I wrote an article about this, about financing and the commoditization of money. Do you agree? Do you think that as we're going down this process, money is more of a commodity now? So there's so many people out there lending, and it's like to your point, it's being so competitive now. We're getting rates at our community bank. We just got a 4.25 rate, a 10-year term, 25-year AM. I mean, they are super competitive out there to get business. And when something becomes a commodity, prices just become the focus, and it becomes super competitive. And, who wins in the end? The consumer wins in the end. Do you think that's what's happening in this market right now currently?
Yeah, to a certain degree. Yeah, in specific markets, we are seeing lenders get pretty competitive. And there's also certain niches out there where lenders will find a niche in a specific market, especially community banks. If they've got a level of comfort, I can think of a number off the top of my head. We've closed a couple of deals just recently in a market just north of Dallas called, Denton, Texas area, where it's gotten extremely competitive, but there are some local community banks that just love that market and just really want to play in that market. And when you've got that, then you can definitely see pockets of that across the country. Another program, I'll give you another example. We had a couple of community banks here in Texas that over the past year we've done a number of transactions with, where they were going in, and as part of there's a Community Reinvestment Act that's out there where lenders are required to reinvest to a certain degree back in the community they do business in. And a couple of specific lenders really wanted to get after it. They had this bucket of money that they needed to put to work, and they specifically wanted affordable housing. So they specifically wanted to go after affordable housing, and for us, the beat, fit that niche. So for about a year there, they're really getting aggressive in a specific market. So that can happen. You can see pockets like that where you find a lender that's really interested in a specific niche, a specific market, and yes, you can definitely see things get extremely competitive. But I would say, that's over the past year. Since I would say over the past couple of months, things are starting to tighten up a little bit in terms of what we're seeing. With the 10-year Treasury, being kind of on the upswing, since the election. And Fed coming out saying that they're going to raise at least 3 times is what we're hearing this year. So, and a level of uncertainty in terms of, with where we're at in the cycle. Things it's competitive, but there is kind of a level of caution that we've sensed, I would say, since election around, hey, what's to come, and, how long is this cycle going to last?
Let me ask you, Ricardo, real quick about the CMBS lenders. What is your feeling about a lot of these loans coming due? They're all coming due up to 10 years in the next few months. What is your feeling about what's going to happen with the market? Do you think there's going to be a deluge of properties coming on the market for sale, or how's that going to affect the market?
Yeah, so we're seeing a little bit of a mix. Some of we've been hearing that for a while in terms of the big slug of CMBS debt that's coming due, and yeah, I think we'll see some of that. We're already starting. A lot of our clients are. We've got a ton of refis. We do a lot of refinances. I just there was a big conference, NMHC, out in San Diego last week, and we got word from a lot of brokers that there is a lot of inventory that's going to hit over the next few months. So I don't know that it's significantly larger than other years, but we'll see. There are rumblings that we may see a certain level of impact there, but I don't know how. It's still kind of too early to tell in terms of how is it really going to be a game changer or not. So we'll see. But we are hearing that we should have a good level of inventory hit the market here at the end of Q1 is what I'm hearing.
Yeah, well, it's funny you say that, because I've been looking at some deals down in North Carolina, and what's really unique about this period is 2006, 2007, a lot of these guys overpaid. And it's amazing that most of these properties I'm looking at have not have not rebounded to where they're supposed to, whether they're being run improperly, whether the NOI is not increased. So for the last 10 years, they're still in the water on a lot of these deals. So I don't know how that's going to shake. I don't know if the CMBS fund is going to come back and actually try to renegotiate the deal, or they're just going to say, hey, I'll see you guys later. So that's going to be interesting to see how that plays out.
It is, and they've owned it for 10 years, and if you've got a property for 10 years, it needs an influx of capital. So not only are they underwater, they probably need a good amount of work. So yeah, there's definitely going to be some opportunity out there. So definitely keep an eye out. How that's going to play out, I don't know. I don't have a crystal ball on that one, but I'm looking forward to kind of seeing where the opportunities are as a lender, and as an investor. So good stuff.
This is one of Jake's favorite questions. He always likes to ask this question. You're scaled up to over 500 units. How have you built your teams, and what advice do you have for team building, which is so crucial in real estate?
Yeah, so I think one of the, if there's a piece of advice in terms of building your team is obviously we all have goals. I would say set them as large as possible. You set a goal. Hey, I want to own, say, 1,000 units. Well, go out and find individuals that own 5,000 units. So reach out to those that have been where you've been, that have been extremely successful. And it can be daunting a little bit. Sometimes going up and trying to connect with someone that has that level of experience. But you'd be surprised on how open people are. So I think it's just getting out there, going to as many networking events as you can, reach out to the right people, find that the one or two individuals that you connect with and really foster those relationships. And I found that, you build one good relationship and, 2 or 3 more come right after that because they have their team, right? So you connect with someone that owns thousands of units. They've got their team built already, so they can definitely point you in the right direction. So it's I think just being as aggressive as you can in terms of getting out there. It's a people business. This is absolutely a people business, and it's a team sport. You hear that all the time, but it's so true. So the more you can do, the better.
Ricardo, what is the best lending or tip for the listeners, especially the newbie investors out there?
Yeah, so really I think, as you're building your team, the best thing to do is to be prepared and, reaching out to a mortgage broker, early on in the process and giving them a feel for, what your strategy is, kind of what your goals are. And then what we like to do is really help, shape those, provide that roadmap and you've got your goals, how do you get from point A to point B, connecting with your lender, your broker up front, instead of after you're already in the deal. We get a lot of calls where folks are, hey, I'm in contract, I'm about to go hard with money, can you help me? And, we do what we can to help. But getting, that roadmap and making sure you've got the right pieces to the puzzle in place early on in the process rather than after you're in contract. I mean, the sooner the better. It'll just give you more confidence, and it'll save you a lot of headaches.
I like that. Let's move over to the short answer section here, Ricardo. Let me ask you, what is your favorite book on lending?
So lending, it's kind of tough because there aren't a lot of, a lot of specific books on lending. There are books on lending, but not, I don't know if there's one that I'd recommend. I would say, just business books in general. I read a lot of, and I think those are the ones that I've gotten the most benefit from. I mean, the one that I've read here recently is the 10X Rule by Grant Cardone. Just finished that over the holiday, and I thought that was huge in terms of, getting the right mindset, thinking big with goal setting and just really, getting after it. So that's one that I'd recommend. If your listeners haven't read that one, that's that one's one you definitely want to have in your toolbox.
What project are you excited about right now?
So we're working on a couple of larger Fannie Mae transactions with a couple of clients right now that we're getting ready to close. And one of the things that Fannie Mae has done here recently, they've come out with a green rewards program. If your listeners aren't familiar with it, but it just came out a few months ago, and it's really a great program because what it does is it provides additional incentives, pricing incentives on rate and leverage. So what they'll do is Fannie Mae will have an engineer come out when they do the property condition assessment report and the appraisal. They'll have an extra engineer come out, and they'll take a look at the property and give you suggestions on ways to save energy. So they'll give you energy saving suggestions. So hey, it's add LED lighting, or add solar screens, or upgrade the windows. And they'll also give you water saving suggestions. So hey, change all the aerators. Upgrade the toilets to low flow toilets. So they'll give you a laundry list of items or suggestions on, hey, how do you reduce your footprint on this specific property? And they'll give you a menu of options, and you can pick and choose. And as long as you hit certain hurdles, and they're really not that. For example, I'm about to close the deal this week with a client that was already going to do water conservation. So he was going to be changing his toilets anyway, changing the aerators, and he was going to be adding LED lights. That was in his rehab already. So just by going through the Green Rewards program, it saved them. He's going to save 30 basis points on the loan and get a little more from a leverage standpoint. It's free to the borrower as long as you do something. It's no additional cost, and it only takes about an extra week in your timeline to get it done. So that's something that's, again, we've just started using it. We've closed a handful of deals here last month, and we're really, especially on rehab deals where you're already going to be doing a certain amount of that work. It's just a nice kiss that Fannie Mae is providing out there for investors. So that's one that I definitely put on the radar. To anyone that's looking at larger deals, let's say over $1 million that have got some rehab. Take a look at that Fannie Mae Green Rewards program.
That's great. I'm glad you mentioned that. Now, awesome program. I want the listeners to know how to get in touch with you.
Yeah, definitely. You can. I'll give my email address. It's RHIN as in Nancy OJOSA at oldcapitallending.com. My direct line, I'll give my phone number, area code 940-597-7367. Shoot me an email, and we've put together a little, we call it our multifamily financing white paper, especially for first-time investors. It kind of lays out a nice, simple roadmap. Okay, what are the different options for first-time investors? From a financing perspective. So something to, help you there. Shoot me an email, and I'll get that out to you.
This has been a really informative and powerful podcast for me, because if you can lock up someone who's going to help you with the financing, that's one of the three legs that we take care of on our on our framework. So I just want to thank you for taking the time out, going through the entire process, giving these guys the experience and just the knowledge of, you got somebody on your team, you want somebody like Ricardo on your team to help you out with the deal. And what I like about Ricardo's story, he's in the trenches. He's an investor, so he knows your pain, and he's also on the lending side. So, that's really powerful. So I just want to thank you again, Ricardo, for taking the time out, and we'll speak to you soon.
Hey, I appreciate the time, Gino. Great to be on, and look forward to talking with you soon.
Sounds good. Guys, by the way, if you found value in this podcast, leave us a review, subscribe. It really helps us out. Take care, everyone.
We trust that you enjoy the Wheelbarrow Profits podcast. Visit jakeandgino.com, your one-stop shop for everything multifamily. See you next time when Jake and Gino share more of their investing secrets with you.